video is over the cash budget and short-term borrowing. I'm your professor, Dr. Stephen Haggard. So now let's talk about the cash budget. How do you know when you're going to need to perform some short-term borrowing? The problem is if you wait until you actually need the money, it might be too late. We would always rather get out in front of these things than wait till the last minute. And we're going to see from some of the forms of short-term borrowing, the quicker that you can get your hands on the money, the more expensive those things are. So wouldn't you rather get out in front of this and be able to borrow at a lower interest rate? So how do we figure this out? Well, the cash budget, we're going to use it to forecast our cash surpluses and deficits. Just in case you don't know, surplus means you've got more than enough. Deficit means you're not going to have enough. And it lets us plan our borrowing to support our operations. Now keep in mind, companies go bankrupt not because they are unprofitable, not because they are poorly managed. Companies go bankrupt because they run out of cash to pay their bills. And so you can be an unprofitable, poorly managed firm and not go bankrupt for a very, very long time. Example, General Motors. As soon as you run out of cash, though, the game is over. So what's the foundation for our cash budget? Well, it's the sales forecast. Let me tell you where sales forecasts come from. They typically come from marketing people. And marketing people, unlike us finance people and engineers and accountants and other technically minded folks, these marketing people are optimistic. In spite of all of their previous experiences to the contrary, they are still optimists. And so what does that mean about the forecasts that we get from them for our sales? They're typically going to be too high. I had a marketing guy named Bob one time, and Bob would always give me numbers for sales forecasts. And Bob was always about 25% too high. And so if Bob would tell me that our sales were going to be 100 in the coming period, I would say, okay, thanks, Bob, and I would write down 80, because 80 times 1.25 gets us up to Bob's 100. So if you are fortunate enough to have a person who's consistent like Bob, who's consistently over-optimistic, you can figure those things out and adjust their forecast accordingly. So let's assume we've already adjusted these numbers that we've received from our marketing folks and that they're actually as accurate as they can be. Now our sales forecast can be weekly, monthly, or quarterly. In this case, we're doing quarterly. So you got to be careful. The finer grain sounds like a great idea, but it's easy for sales to slip from one week to another. It's not as easy for them to slip from one month to another, and it's even harder for them to slip from one quarter to another. So if I were you, I would, at the minimum, look at things quarterly, and at the maximum, look at things monthly. So notice that these are predicted sales. So there's forecast risk involved in our planning. If you're old enough, certainly you've lived through some times where suddenly things happen. Financial crises, stock bubbles burst, virus pandemics. These things can all cause problems for our sales forecast. And not only that, more mundane things like a competitor introducing a better product, that can also cause us problems. So we're told that the firm starts the year with accounts receivable of 120 and has a 45-day collection period. Hopefully that means we're telling our customers to pay in 45 days. If we're telling them to pay in 30 days and they're paying in 45 days, then we need to get to work calling them on the phone demanding to be paid sooner. So we start by figuring out the firm's cash collections. We're going to assume that all of the outstanding accounts receivable will be collected by the end of the first quarter. Why would we assume that? Well, we've got a 45-day collection period, and quarters typically have around 90 days in them. And so we should have all of that 120 that's outstanding collected in the first 45 days of the first quarter. We're also going to assume that we're going to collect half of the new sales for the quarter. Well, think about the first 45 days of the quarter. Those things are going to be due for payment before the end of the quarter. So we will hopefully collect that money before the end of the quarter. And half of the quarter sales, the last half sales, will be collected after the quarter's end. And so that's going to become our beginning accounts receivable for the next quarter. So we've got our sales forecast up there, and we start out with our beginning receivables. And we have sales of 200. And so that brings us up to 320 that we are owed. And then we are going to collect cash. We're going to have two sources of cash that we collect there in the first quarter. We are going to collect 120, the stuff that we were owed from the prior quarter, and half of the current quarter sales. Well, the current quarter sales are 200, and so 100 is half of that. 100 plus 120 is 220. And so when I take 320 minus 220, I end up with 100 remaining in receivables. And that is my ending receivables for the quarter becomes my beginning receivables for the second quarter. Now in that quarter, we're expecting 300 in sales. And I expect to collect half of that, or 150, during the quarter. Plus, I expect to collect that 100 beginning receivables. And when I add 100 and 150 together, that gives me my cash collections of 250. And when I subtract that out, I end up with ending receivables of 150. And of course, my ending receivables for the second quarter becomes my beginning receivables for the third quarter. The third quarter starts with 150 in receivables. We plan to have 250 in sales. Half of 250 is 125, so we expect to collect 125 along with the 150 we are owed at the beginning, so that's 275, and that leaves us with 125 in receivables at the end of the quarter. And that becomes our beginning receivables for the fourth quarter, where we plan to have 400 in sales. We're going to collect half of that 400, or 200, plus the original 125, so we'll collect 325, and once we do, we will have ending receivables of 200. So now we know what our cash inflows look like. Next, we need to consider our cash outflows. So what kinds of things are we using cash for? Well, first of all, to pay our accounts payable. That's the money we owe to our suppliers. We also owe wages, taxes to our employees, and their other expenses, like the light bill. And then we have capital expenditures. Perhaps we're going out to buy a new machine. And then there is the long-term financing expense, such as interest or dividends. Those definitely represent cash outflows, and we definitely need to think about them when we are discussing what to do with the cash at the firm. So here we have our cash outflow estimates. And if we look at payment of accounts receivable, we note that it's 60% of sales. Now that makes all the sense in the world because our accounts payable should be related to our sales. We're buying things and then turning around and selling them. If it's a manufacturing operation, we're buying raw materials. If it's a retail operation, then we are simply buying goods at wholesale and selling them at retail. So we've got 60% of sales is our payment of accounts. So 200 times 0.6 is 120. 300 times 0.6 is 180. And 250 times 0.6 is 150. And 400 times 0.6 is 240. So that's where our payment of accounts payable comes from. Then we have wages, taxes, and other expenses. Now they don't mention it here, but these are actually 20% of sales. If you notice, they are exactly 1/3 of the payment of accounts. And it also makes sense that our wages and our taxes and other expenses might go proportionally with our sales. And then the third line down is capital expenditures. And notice that in a typical quarter, we don't have any capital expenditures, and that makes a lot of sense. But it looks like in the second quarter, we are perhaps buying a new machine or a new cash register, a new something. Basically, something that's going to last us more than 1 year. And that's going to be a cash outflow of 100. Now be careful. Think about what accountants talk about when they talk about depreciation. They say, oh, no, that capital expenditure isn't really 100 right there. It's depreciated out over the life of the asset. That's not true. From a cash perspective, the cash all flows out at the time that you buy the item. And it's going to impact your cash in a real way. And so we need to look at that directly at the time we make the expenditure. And then finally, we have our long-term financing expenses. This would include our interest and dividends. And it makes a lot of sense that interest and dividends would remain the same over the quarters, because hopefully we're not out there borrowing loads and loads more of money. And so now we have our total cash disbursements. We can simply take our payment of accounts, add the wages, taxes, and other expenses, our capital expenditures, and our long-term financing expenses. And when we do that, we have 180 in the first quarter, 360 in the second quarter, 220 in the third quarter, and 340 in the fourth quarter. Now notice that the second quarter is a bit of an outlier. Even though sales are not all that great, we have these huge cash disbursements, and that's totally as a result of our capital expenditures in that quarter. So we're going to put all this together. Next, we're going to subtract those cash outflows for each quarter from the cash collections for the same quarter. And that's going to tell us whether or not we are going to have a surplus or a deficit for each quarter. To make this really work right, you need to know how much you have in cash to begin with. And so let's say that we have 100 in cash to begin with. At the end of the first quarter, our net cash flow is positive. It's 40, and so we would have 140. In quarter two, we have 110 deficit, so now we are down to 30. 140 minus 110 is 30. And then we're going to have a positive 55 in the third quarter. That brings us up to positive 85. And then in the fourth quarter, we are going to be minus 15, which brings us down to 70. And so if we start out with 100 in cash, we're going to be just fine. However, what if we only started with 50 in cash? At the end of the first quarter, we would have 90. At the end of the second quarter, we would have negative 20. Now, that's a problem, because having negative cash is indicative of bankruptcy. So what are you going to do? This is where we have to go out and do some borrowing. Now let's talk about the borrowing that we would do. If this deficit of cash were being caused by short-term things, then what we would do is arrange some sort of short-term financing to get us through this. In other words, we would go out now and try to borrow the additional money that we need to stay positive on our cash balance. But what if the problem is caused, such as it is here, by a capital investment? We typically say that you want to finance long-term assets with long-term financing. And so if I've got a machine that's going to last 5 years, perhaps instead of doing a short-term loan, I would go out and get a 5-year loan to purchase that machine. So be careful about always thinking that you need to meet these financing deficits with short-term borrowing, because if you're looking at a capital investment, you might be better off to actually do it with long-term borrowing. Okay, so we've already talked about the first bullet point here. But something else that we need to point out is that our figures are estimated. The sales could actually be worse. Now, the sales being worse would also reduce our cash disbursements, except for that capital expenditure. And so it's going to be somewhat mitigated there, but not totally. And once again, we need to meet those forecasted deficits if they're caused by short-term issues. We do that with short-term financing, borrowing, or if they're long-term issues, we would do it with longer-term borrowing. Okay, now we were talking about that last example, had a long-term capital investment, so we probably want to fix that deficit with long-term debt, but we could also address short-term cash deficits with short-term borrowing. And there are basically two kinds of short-term borrowing that you can undertake. There is unsecured borrowing and secured borrowing. Well, what do we mean? Let's talk about secured borrowing. When you go out to buy a car, the car acts as the security or collateral for the loan. If you don't pay your car payments, they're going to send someone out called a repo or repossession person to repossess your car. And so the car is acting as the security for the loan. However, you can get loans at the bank called signature loans. Those are unsecured borrowings. If you don't pay, then they basically have to come after you for your general assets because there's nothing specifically named as being security for that loan. Now, which is riskier for the lender? Unsecured borrowing. With secured borrowing, it's easy enough to go grab your car, your machine, or to foreclose on a house. But with unsecured borrowing, basically you have to force this person into bankruptcy, and then you have to line up with all the other folks that they owe money, line up with them in bankruptcy, and try to get your money back. As a result of this risk, unsecured borrowing is going to be more expensive for the borrower because risk and reward must go together for the lender. So what are the different kinds of short-term borrowing we can look at? Well, let's start by talking about the line of credit. That's an agreement under which a firm is authorized to borrow up to a specified amount from a bank. Now, they don't have to borrow that money right off, and they don't have to borrow all that money at once. It's up to that specified amount. And so you could have $1 million line of credit and not borrow against it at all. In fact, a lot of times these lines of credit are being used as a backup source of funding in case everything else goes horribly wrong. So these things are typically evaluated on an annual basis. So what I'm going to do is say that we will loan you this money for 1 year, and then we are going to reevaluate whether we would like to continue to allow you to borrow this money on this line of credit. And we make these things subject to what's called a cleanup period, usually something along the lines of a month. Now, what does this mean? It means that if they've borrowed against the line of credit, they must pay off the money they owe and keep it paid off for at least 30 days before they are allowed to start borrowing again. Why would we do this? Well, what we want to do is keep our short-term borrowers from turning their line of credit into long-term debt. Typically, long-term debt carries a higher interest rate than short-term debt, and so you will see certain types of scumbags try to turn their short-term debt into long-term debt. We're going to use this cleanup period to make sure that doesn't happen. Now, with a line of credit, it can be committed or uncommitted. Committed, as you can tell, has a stronger feel to it. The firm, as long as it meets certain base requirements, is always able to borrow under a committed line of credit. Whereas with an uncommitted line of credit, it's possible that you might go to draw on your line of credit and the bank would just say, "Sorry, pal, we're not going to be able to help you this time." And so, of course, that means I would rather have a committed line of credit if I were a small business person. But The bank knows that's valuable to you and it's risky for them, and so a commitment fee, they would require you to pay this thing called a commitment fee in order to get your line of credit to be committed. Next, we have the revolving credit arrangement. It's much like a line of credit, but it's open for 2 or more years. And so both the line of credit and the revolving credit arrangement, you can borrow, then pay down, borrow, then pay down over the life of the agreement. So it's kind of like a credit card. In fact, your credit card is a form of revolving credit. A compensating balance is money that the firm must leave on deposit with a bank at little or no interest in order to receive a loan from the bank. And so it might go like this. I'm allowed to borrow $100 million, but I have to leave $10 million of that in the bank, and I'm not allowed to collect interest on it. Now, there are a couple of reasons that the bank is doing that. Number one, that is $10 million that they are not paying for now that they can turn around and loan out to other borrowers. And two, that's money that can be used to basically make your debt payments if you were to default on a short term. That gives them some flexibility to keep you current without forcing you into bankruptcy. And so the compensating balance is there. And the reason it's called a compensating balance is because this is how one way you are compensating the bank for making a loan to you. And then finally we have the letter of credit. A letter of credit is a promise by a bank to make a loan if certain conditions are met. So let's talk about where we might see letters of credit. They're typically involved in international trade. So let's say that you are a coffee shop in Cleveland and you want to buy some very special beans from a man named Juan Valdez in Colombia. Now, you've never met Juan, and he's never met you. And so you don't know if you can trust Juan, and he doesn't know if he can trust you. But you can go down to your local bank, and you can get something called a letter of credit. And you can send it to Juan, and it basically says that if he produces the beans at the port on or before a certain date, and they pass third-party inspection, which is where someone comes and looks and makes sure it's the right product, then he can, the bank promises that they will loan the money in order for me to pay for those beans, the coffee shop owner to pay for those beans. Now, when Juan takes his beans down to the port, with his letter of credit, he will collect the bill of lading and the certificate from the third-party inspector, and he will take all that to his local bank. And they will transmit the information back to the coffee shop owner's bank, and at this point, it will become a banker's acceptance. And Juan can wait 30 days and get paid the full amount, or he can sell that to his local bank at a discount and get his money now so he can go back into the mountains and pick some more coffee beans. And so now the banks are the ones that are handling the money. Why does this work better than just having Juan and the coffee shop owner conduct business? The reason is trust. Juan and the coffee shop owner are in perhaps what is a one-time game, and so they have all of the incentives in the world to rip each other off. But the two banks may have multiple interactions over time, and they certainly have reputations to protect. And so in this case, what we are doing is substituting the trustworthiness of the banks for the trustworthiness of the individual parties involved in the transaction. Now, these letters of credit can be revocable or irrevocable, which is very similar to the committed or uncommitted line of credit. And I guarantee you, if I'm doing business with someone, I would like an irrevocable letter of credit. Irrevocable means that they can't go back on their word. I would imagine, therefore, that an irrevocable letter of credit requires a higher fee than a revocable letter of credit. Let's talk about the cost of a compensating balance. So if we talked about earlier, when you borrow money from the bank, sometimes they force you to leave some of that money on deposit with the lender for little or no interest. And that actually represents a financing cost to the borrower. Let me show you how that works. We're going to start with the quoted interest on the credit line. It's 16%. By the way, credit lines typically have higher interest rates, which is why people don't want to tap them unless they have to. So the lender requires a 10% compensating balance. We need $54,000. In order, if we just borrow $54,000, though, we will not receive the $54,000 because we'll have to leave $5,400 of that on deposit with the lender. And so that means we actually need to take 50,000 divided by 0.9 because 54,000 is 90% of the amount we actually have to borrow. And when we do that, it shows us that we must borrow $60,000. And so we're actually going to be paying interest on that full $60,000. That's $9,600. And we're paying that interest, in essence, to borrow $54,000. So our true cost is $9,600 divided by $54,000, or 17.78%, not the 16% quoted rate on the line of credit. So let's talk about some secured short-term borrowing. Accounts receivable financing is very popular. Like, remember, accounts receivables are assets, and just like you can borrow against other assets like a house or a car, you can borrow against accounts receivables. And so the first way that we'll talk about would be likely through a bank, and it's called assigning receivables. And what we do is we talk to the bank about borrowing money, and we set aside certain receivables as basically the security for that loan. In the case that we do not pay the loan, then the bank is allowed to take possession of those receivables and collect them. So that's assigning receivables. The bank does not become the owner of the receivables unless the borrower fails to pay. The bank really isn't interested in collecting your receivables for you. They would rather you just pay your loan. Now the next kind is called factoring receivables. And factoring is a little different. This is where the lender, a person called a factor, basically buys your accounts receivables from you and then turns around and collects them. Now that means they must only be willing to purchase at a discount for at least two reasons. Number one, the time value of money. Your receivables aren't coming due for 30, 60, or 90 days, and so they are out the cost of their money during that time. Secondly, we know that not everybody pays their bills, and so there are likely to be some bad debts that need to be covered. And so what we likely will see here in conventional factoring is that they will buy your receivables for something like 90 cents on the dollar. Now this only really works out for businesses with high profit margins. For example, it's popular in the clothing industry. If you didn't know it, the profit margins in the clothing industry are obscene. When they are selling you something at 50% off, they're still making a profit. And so for the clothing industry, factoring receivables makes a lot of sense. Conventional factoring, you can immediately sell your accounts receivable for 90% of their face value. With maturity factoring, we are basically going to receive the money at some point in the future. And so you might be receiving the money 2 weeks from now. And because of the shorter time that those things will be outstanding for the person that's loaning you the money, which, by the way, the name of that person is called, they are called the factor. So the factor has their money outstanding for less of an amount of time, and so that's going to be less expensive. I would imagine that conventional factoring is far more popular simply because people get the money now. And the reason people go to factors is because they need money now. And then we have credit card receivable funding. So if your business uses credit cards, then every time that you run the credit card, you do not receive cash at that time. It's going to take a while for you to get that cash. So in the meantime, you have a credit card receivable. The people who are running your credit card transactions, they see what your credit card transactions are, and they know what your credit card receivables are. And very often, they would be willing to extend you credit based on those receivables. And it's actually fairly safe for them simply because they know that those credit card receivables are going to eventually get paid. And since they are the ones that are sending you the check for your credit card business, all they have to do is deduct their part out before they send it to you. And so it's actually fairly safe for the credit card, for the person doing the lending here. However, this is still an expensive form of borrowing, and I don't necessarily recommend it. Next, we have inventory loans. We have the blanket inventory lien, and that is where we just borrow against our inventory. Now, this is an interesting idea. If you borrow against the entire inventory, what that means is that if I don't pay, then they can come and take my inventory and sell it off to satisfy the loan. But they also need to be assured that I actually have the inventory. And so the person loaning me the money will send someone to check on my inventory from time to time. And they will do a random spot check of what I say I have in my inventory versus what I actually have in my warehouse. And I have previously studied some frauds where people would fake the amount of inventory. Of course, they fake it on their books, but they also fake it in the warehouse. The one that I'm thinking of in particular was an electronics dealer back on the East Coast, and they basically built a wall of televisions and claimed that there was an entire cube of televisions behind the wall. Instead, if you look down inside this cube, you would see that it was absolutely hollow. And the auditor that was checking on the inventory for many years was an elderly gentleman, and he was not that physically able, and so he always just took them at their word that there were TVs in the middle of this big cube. Then the elderly auditor retired, and a young 23-year-old took his place. And the 23-year-old came to do his first audit and was looking at everything, and everything seemed just fine. And he said, one more thing. Why don't you get a ladder and bring it over here, because I want to take a peek over the top of your inventory. And so the warehouse hands went and fetched a ladder, and the young man climbed the ladder and looked down and saw the canyon inside of this supposed cube of TV boxes. And thus the fraud was uncovered. Next, we have trust receipts. This is a way that car dealers and appliance dealers can put cars and appliances on their lots or in their showrooms. A trust receipt it mentions specifically the serial number of the item that's being financed by it. And that item then is the collateral for that. And as soon as that item gets sold, then that trust receipt loan has to be paid off. And so this is it's a very specific way to have security for an inventory loan. And then finally, we have field warehouse financing. Back under blanket inventory lien, we discussed that there's a possibility of fraud. But what if we have a third party that watches over our inventory in their own warehouse? And they could serve as a credible certification that we actually have that inventory in the warehouse. Or better yet, what if the field warehouse belonged to the lender? In fact, Amazon.com does this. the goods that you have as a seller in their warehouse, they're willing to extend you credit against it. And they know that the inventory actually exists because it's in their warehouse and you don't even have access to it. And so this is another way we might see of people getting an inventory loan. So what are some other short-term funding sources? Before the financial crisis, the commercial paper market was very big. Commercial paper, you can think of them as being like corporate bonds, only done on a very short term. And they are unsecured and they have no coupons, and so they sell basically at a discount to the face value. They are sold directly by the firm to lenders, and they have a maturity less than 270 days. Why less than 270 days? Because if we go beyond 270 days, then these things have to be registered with the Securities and Exchange Commission. And we don't want to go through that trouble, time, and expense. And so we only want to borrow this on the short term at the less than 270 days. These have lower costs than bank loans, similar to the ways that corporate bonds have lower costs than long-term bank loans. That's because you're going directly to the source of the funds instead of through an intermediary. Remember, the bank's just an intermediary between the people who actually have the money and the people who need the money. And then finally, we have trade credit, and that is where you use your suppliers as a source of funding. Your accounts payable is their accounts receivable. And so what you could do is to pay your bills more slowly to build up additional trade credit. Now, once again, I would advise you to always pay in accordance with the terms. Do not go out past the terms because that's unethical. These people need their money in order to be able to continue their business and to pay their employees and feed their families. However, you will see people abusing trade credit. One time, I was giving pro bono consulting to a local firm here in the town where I live. And I was looking at their charts on the wall, and their days sales and receivables were just going up, up, up. And I turned around and I looked at them and I said, "Do you consider your customers to be your friends?" And they said, "Of course." They said, "How did you know?" I said, "Because your friends are taking advantage of your good nature. They are treating you like a zero-interest bank. You need to do a better job of calling them and asking for the money." Their clients were doing an excellent job of using their suppliers as a source of funding.